This is part 1 of the series of explaining what Bitcoin is, how it works and why it was created, what has happened since it started being used and where Bitcoin goes from here. If you want more videos in this series, subscribe, like and smash that notification bell so you do not miss the next episode. Once it drops, it's going to be fire. About Bitcoin, BTC. Bitcoin is the world's first decentralized cryptocurrency that enables peer-to-peer electronic cash transactions without intermediaries like banks or governments. Bitcoin operates on a blockchain secured by proof-of-work mining and the SHA-256 cryptographic algorithm, making it virtually impossible to counterfeit or double spend. With a fixed supply cap of 21 million coins and programmatic halvings every 4 years, Bitcoin is designed as a deflationary digital asset, often called digital gold. Bitcoin has achieved mainstream adoption through spot ETF approvals, corporate treasury holdings, and acceptance by governments and institutions worldwide. Who created Bitcoin? Bitcoin was created by an individual or group using the pseudonym Satoshi Nakamoto, whose true identity remains unknown to this day. In October 2008, Nakamoto published the Bitcoin whitepaper titled Bitcoin, a peer-to-peer electronic cash system, laying out the technical foundation for a revolutionary digital currency. The first Bitcoin block, known as the Genesis block, was mined on January 9, 2009, marking the official launch of the Bitcoin network. Nakamoto actively developed Bitcoin and communicated with the early community until mid-2010, when they handed over control of the network and disappeared from public view. Despite extensive investigation and speculation over the years, no conclusive evidence has emerged regarding Nakamoto's true identity. Nakamoto is estimated to hold approximately 1.1 million Bitcoin mined during Bitcoin's early days, spread across roughly 22,000 wallet addresses. These coins have remained untouched since they were mined, and any movement would likely cause significant market impact. How does Bitcoin work? Bitcoin operates as a decentralized peer-to-peer network where users exchange value directly without intermediaries. The network maintains a public ledger called the blockchain, which records all transactions chronologically. This ledger is distributed across thousands of computers globally, with each node maintaining an identical copy. Transactions are grouped into blocks, with each block containing a cryptographic hash of the previous block, creating an immutable chain. New blocks are added approximately every 10 minutes through mining, where specialized computers compete to solve complex mathematical puzzles. The first miner to solve the puzzle adds the next block and receives newly minted bitcoins plus transaction fees. No single entity controls the network. Changes require widespread consensus among users, miners, and developers. Users control their Bitcoin through private keys, cryptographic codes that authorize transactions and prove ownership. The smallest unit is a Satoshi, 0.0000001 BTC, allowing Bitcoin to function as both a store of value and medium of exchange. Bitcoin security, SHA-256 hashing algorithm. Bitcoin's security is fundamentally rooted in the SHA-256 cryptographic hash function, a proven algorithm also used to secure critical government and internet infrastructure. This function is essential to the network's operation. Miners must use it to find valid hashes to add new blocks, and it is also used to create the digital signatures that verify transaction ownership and authorize payments. The algorithm is designed to be collision-resistant and pre-image resistant, meaning it is computationally impossible to reverse engineer an input from its output, or find two inputs that produce the same output, making the network virtually impossible to counterfeit or brute force. The energy consumption debate. Bitcoin's proof-of-work consensus mechanism is energy-intensive by design, requiring significant computational power to secure the network, which has led to widespread debate about its environmental impact. Critics highlight the network's substantial electricity consumption, which rivals that of entire countries, and its associated carbon footprint when powered by fossil fuels. Proponents counter that this energy expenditure is justified to secure a global, decentralized financial system. They also point to market-driven incentives for miners to seek out the cheapest power sources, which often include stranded renewable energy like excess hydro or solar, and the capture of flared methane gas, which can arguably help stabilize power grids and monetize otherwise wasted energy. How to keep your Bitcoins safe. Securing Bitcoin means protecting private keys, the cryptographic codes that prove ownership and authorize transactions. The golden rule of Bitcoin security is, not your keys, not your coins, meaning whoever controls the private keys controls the associated Bitcoin. As a general rule, private keys and seed phrases should be kept offline and away from internet-connected devices. Hardware wallets provide the highest security level for most users, and these are optimal for long-term storage of Bitcoin. These physical devices store private keys offline and require physical confirmation for transactions. Software wallets on computers or smartphones offer convenience but require stronger security practices. Users should enable two-factor authentication, use strong, unique passwords, keep software updated, and avoid storing large amounts in hot wallets connected to the internet. Users keeping Bitcoin on exchanges face different security considerations. While exchanges provide trading convenience, they control your private keys, and major exchange failures like Mt. Gox 2014 and FTX 2022 resulted in major customer fund losses. When choosing an exchange, select exchanges with strong security track records, enable all available security features, and transfer Bitcoin to personal wallets for long-term storage. Bitcoin loss is permanent and irreversible. It is estimated that around 20% of all Bitcoins are lost forever due to forgotten passwords, discarded hard drives, or deceased owners without backup plans, underscoring the importance of secure backup procedures and estate planning for Bitcoin holders. Understanding Bitcoin's price and volatility. Bitcoin's price is famously volatile, with the potential for large, rapid movements. This behavior is not a flaw, but a natural characteristic of a new, global asset class with unique market dynamics. The main drivers of volatility include fixed supply, fluctuating demand. This is the primary factor. Since the supply of Bitcoin is fixed and cannot be increased to meet demand, any shift in market sentiment, whether from positive news or negative FUD, fear, uncertainty, and doubt, has a direct and often immediate impact on its price. A 24/7 speculative market. As a new asset, Bitcoin's price is heavily influenced by speculative trading. Because the market never closes, it reacts instantly to global news, regulatory announcements, and shifts in investor sentiment. Market liquidity. While the Bitcoin market is large, it is still smaller than traditional markets like gold or major stock indices. This means that large buy or sell orders, from whales, can have a disproportionate effect, causing the price to move more sharply than in more liquid markets. Macroeconomic sensitivity. As Bitcoin has become a mainstream asset, its price has become increasingly sensitive to global macroeconomic factors, such as interest rate decisions by central banks, inflation data, and geopolitical events. What makes Bitcoin valuable? Bitcoin's value stems from solving the double spending problem without trusted intermediaries, creating the first truly scarce digital asset with a fixed supply cap of 21 million coins, enforced by transparent, unchangeable code. Bitcoin's decentralized nature provides censorship resistance. No government, corporation, or individual can control the network, freeze accounts, or prevent transactions, making it particularly valuable in regions with unstable currencies or authoritarian governments. Once confirmed, transactions become practically irreversible. Digital gold narrative. Bitcoin has earned the digital gold moniker because it shares many properties with the precious metal. It is scarce, durable, and not controlled by any government or central bank, making it an attractive store of value and a potential hedge against inflation. Unlike physical gold, Bitcoin is easily portable. Billions of dollars in value can be sent across the globe in minutes. Highly divisible. It can be divided into 100 million smaller units, satoshis, making it useful for transactions of any size. 45. Easily verifiable. Its authenticity can be proven on the blockchain without a trusted third party. Disclaimer. This video is for entertainment and educational purposes only and is not professional financial advice in any shape or form. Always, do your own research. Like and subscribe for more content like this.